Hey guys, this is Kunal from TradingSim. I wanted to do a quick market recap on the action that we saw on Friday, June the 24th. As most of you know, the Brexit news came out. Great Britain decided to exit the Eurozone, and that basically caused a mini crash in the markets. Um, the world markets were down significantly. The S&P was down close to 4.5% on Friday. At one point, Nikkei was down, trading down over 8%, and so there was tremendous amounts of volatility on Friday due to that news. And so what I wanted to do is, just before we take a look at the intraday trading activity, I wanted to just step back and kind of look at the big picture and kind of see where we're at. Um, so real quick, if you look back on this chart, I've taken it back almost 2 years. Um, yeah, so we've taken it back, 2 years plus, and I think what's really interesting to me is, we got a very, very massive range on the S&P 500. Basically for last 2+ years. We've been trading in this range from this 1800 area, 1820, up to this 2130. So we've been trading in essentially a 300-point range that there's just been tremendous volatility, up and down. There's been, like, you can look at the charts here, like one, two, three mini crashes. I wouldn't even say mini. I mean, they were pretty big, large declines in a very short amount of time. And so, at each time though, the market did hold. And so, from my vantage point, that's a good sign for the market. From a bearish perspective, when we look at what's going on up here in this 2050 to about 2130 area for the last year and a half, is the market is just stalling at this 2130 area. And so as traders, we just need to know these ranges. And so from my perspective, from a long-term perspective, and if I pull up a monthly chart, right, I'm very bullish on this stock market, long term, right? So this chart goes way back to the 70s, but what we saw here was a gigantic ramp from 94 up to into that 2000 top, and then what we saw for the next, let's call it the next 13 years, was just a sideways consolidation. It was a massive range, but it was a pretty huge sideways consolidation range that you can look at. And so when we look at it from a Elliott wave perspective, and I'm no Elliott wave trader, but I do like to dabble in it a little bit. We kind of look at this consolidation as our wave 2. So really, this was a big ramp, wave 1, sideways wave 2, and now basically we had this gigantic crash in 2008, and that led to a really nice shakeout right here. Trapped a lot of bears down here, and then the market just ripped like nobody's business, right? And so it rallied 300%. We broke out through this range at about 1550 on the S&P, which is a big area for 13 years. And so we took that out and just ran, another 500 points, really without looking back. And so what the market is doing up here in a monthly chart, when you put everything in perspective, this is just another, really, a consolidation going on of some sort. This is a 2-year consolidation up here. So, this 300-point range, until it's broken either way, I'm not really going to get bullish or bearish. And really, if I go back to our daily charts, the risk reward at this point is on the downside, right? There's more risk to the downside than there is risk to the upside. And if I look at the chart, I'm already at this top of this range. We know it can't get through this area. And so, we just want to be very cautious in this area. If this area starts to break down, especially on the short term, right around this 2030 to 2040 area on the S&Ps, we want to get defensive, because the upside risk is, about 4% on the S&P, and so I'd rather be defensive, be out of my positions in the anticipation that, there's 4% upside here potentially. I could always buy it if the breakout occurs, but the downside is a good 10% potentially. Right? We've been down here 5 times since April of 2014. And so there is a definite possibility that we could come back down to the bottom of this range again. And so let's just keep that in mind. And let me just kick this simulator off. And so you can kind of see when Brexit was announced, quite honestly, when the futures hit a low about 2007 on the S&P futures. And so this area where it opened at 9:30 Eastern was significantly higher than that low. Let me just pull up this short-term chart. Right, so we know we got some pretty big support here. This is support back from April, basically, end of March, April, and we went ramped right back up to this 2125 area and just could not get through. Now what's happening is the S&P is trying to test the bottom of the range. If we take out all the fear and the news that was driving the move on Friday, let's just take it out and look at the charts and see what's happening. We know for a fact that we have this established range here. So we're not going to get overly bearish until we see the range break. Right? And so that's just not something we saw. That doesn't mean that there couldn't be a major move down come Monday morning, and we get Black Monday or something like that. But the market generally respected that area. I'm going to pull up the intraday charts because it's a mixed picture right now. I did not like the action that I saw on Friday. And so from my perspective, I got defensive, and my long-term portfolio got very defensive after this move. But let me just pull up the 5-minute chart here. So, what we ended up seeing in the morning was a gap that was bought, and let's just move this thing a little bit. Okay, I'm going to pause this. So you can see we 2038 was basically the low of the morning, and you can see that the support line that we had on the daily charts. I mean, we came right down to that area, give or take a couple pennies there, and we started to run. And so I think what happened here is a lot of traders, and probably a lot of big traders, got trapped in this move. And so what we're going to be looking at right here is we're going to be looking to see what happens come this 9 EMA. That's going to be a very important gauge for us to kind of figure out what's going on. And if we look at the intraday charts here, we have this big area right here. So that's just another area that we want to kind of be focused on. There was a gap here. There was a gap. So this range, give or take, a couple of pennies. This is going to be an important area for the market, and if the bulls want to take control of this, they can, and if they get it through this and get it right back up through this area, they can take control of this. And so let's just see what happens. Right, everything is looking pretty good here. I even took short-term scalps on this breakout here. But on a day like today, right, you got to realize something. the character of the market has changed. We saw this back in January of 16, and we saw that extreme volatility kick in, and then once that volatility kind of subsided, come the March time frame, we started to rip in the market to the upside, and the character of the market, changed. We didn't see those 2% range days on the S&P every single day anymore. So now what we're doing here, if you go back to the daily, right, we're introducing that massive volatility again. So we want to be very alert as day traders. You want to be very quick to take your losses. You want to make sure you pare your position sizes down. The volatility in the market will more than make you whole for the size that you're reducing, and it's just not worth getting your shirt ripped off in this type of environment, because it's fast and it's furious, and you can lose money very quickly. You can make money very quickly if you know what you're doing, but you can also lose it very quickly. So the key in this market to stay alive is kind of be defensive. That would be my big piece of advice there. So anyways, we're coming up here into the 9 EMA, you can see here, and we want to see this thing get through, and it didn't. And so on an intraday basis, this 206 area became intraday support. Let me just go to the 1 minute chart just to give you guys a little better idea. So this 206 area became very critical intraday. Number one, we hit the 9 EMA right here, and then from an intraday support resistance area, this is a big level. So if that support level gives way, you can start to look to take a short position again. Go back to the 5 minute. And so you can kind of see it did give way. It pushed down, tried to come back up through the 9 EMA. So on a break of 205.59, you really could take another short, because you see it's violating this 205.75, 205.85 area. It's been violated. That previous breakout that I mentioned that occurred earlier in the morning, and so on that break of that low right there, you could have gone short again. And this is a day trader's dream, quite honestly. I mean, you get this rip into the morning, come into that 9 EMA, you come into this major resistance area, right, that we drew up here. And so if I just pull it back a little bit, right, this was that gap area from a previous, I think, couple days ago. We came right into there, we came right into the 9 EMA, nothing doing. And so what this is kind of telling me is that a lot of big institutional investors were basically ramping the market so they can start unloading their positions. Once they did that, support in the market, the bid came out of the market, and it just started going lower again. And if I keep moving through this simulation, you can kind of see this thing is respecting the 9 EMA pretty well. Here was a little juke move, but what did it do, right? If I just pull one of these support lines, I don't want to keep drawing too many lines, but what did we do? We just came back to that breakdown area and tested it, and it's obeying the rules pretty well here. And so we went up there, we came right back down. None of these bars are really closing above the 9 EMA in any significant way. And so this thing from this 205.65 area where you could have gone short, we're already at 204.18. I mean, that's a 15-point move on the S&Ps. It's incredible volatility. And so right there we started to uptick through that 9 EMA. You know, we tried here, we failed, and then we took out that level at 204.58. So, you know, you could have been stopped out at that level. You know, and that also, you know, that was also a previous, you know, support level. So that was a decent intraday level that was taken out. So eventually the market does move lower, but from a risk management perspective, you know, you wanna take your stops, and you want to book your profits. I mean, that was a pretty healthy gain. And so if I just keep moving, you know, the one thing I did not like about this, I mentioned it earlier in the video, one of the things I did not like about the way this stock closed, or this market closed, was, you know, we took out the opening and basically closed at the lows of the day. That's just not activity I like to be seeing for a healthy market, right? And you can see again, we dumped into the close here in the last couple minutes. Nobody wanted to hold it on Friday night, and you know, you can't really blame them. Don't really know what's going to happen Monday morning, but I mean, this was a very, you know, we talk about this 9 EMA, and we talk about trending stocks, and you know, this is a very good example of a trending stock that's obeying the 9 EMA. It's obeying support and resistance levels for the better part of the day. You know, and this is the kind of stock you want to trade. It was unfortunate the market went down this heavy, but you know, the S&P became you know, a hot mover of the day basically on Friday, and that's kind of how we trade these hot movers of the day. You know, and if I go back to the daily chart, you know, we're going to want to keep an eye, very close eye on this 2025 area on the S&P. If that starts to get violated, you know, what do we have to look forward to? I mean, we have potentially a 50% retracement to look at. You know, we have an area of support right around here. It's not really that big, quite honestly. And we have another one right here, which is a little more significant, right at 1950. And if we do a Fibonacci, I'm just going to do one in my head real quick, but 181 to about 2125, right? That's 315 points. If I take half of that, it's 165 points. Sorry, about 160 points is about a 50% retracement. 160, 1810. You know, we're talking 1970 on the S&Ps, and that's kind of what this range represents. We could potentially break down through there. We'll come to this area potentially, and we'll see what happens. I think if we start to breach the 1950 area, we're most likely going to head back to the bottom of that range. And so the long and short of it is, from a long-term trading perspective, my thought process here is to be risk averse and defensive. And I've cleared out my long-term portfolio, and I'm really strictly going to be looking at intraday trades. And so, you know, if the market wants to go higher, great. I'd welcome that, because at the end of the day, I do think the S&P is going to go significantly higher. My next target is around 2,800, which could take a couple years to play out, but that's kind of where I end up seeing it going before we see a real large retracement. So in any case, I hope I know this was a long video, but I wanted to kind of talk to you about the long-term picture and what I see happening. But I also wanted to show you, more importantly, from a day trading perspective, how we would have looked at this. So if you have any questions, I know this is a very crazy time in the market. Email us, admin@tradingsim.com. You know, shoot us a comment on YouTube with any questions, and I wish you the best of luck.